Hi, I welcome you all to Be Informed session where we talk to industry leaders. And today we have Mr. Chintan Haria from ICICI Prudential Mutual Fund. Welcome, Chintan.
Hi, thanks Anand, and
Hi,
hello to all
Chintan.
viewers.
Welcome.
Hi, Girish.
Chintan joined ICICI in October 2005 and has rose through the rank to become a fund manager. He's also the head of product development and strategy. He manages a couple of funds right now, and his investing style is both a mix of top-down and bottom-up approach. But he's a very valuation conscious investor or a portfolio manager while creating portfolio, which is rare to see these days. And he's also an MCom from Sydenham College and also a fellow member chartered accountant from ICAI. So with that, I want to start with a question around everybody's mind, which is: are the valuation of value stocks cheap, and do you suggest investing into those, Chintan?
Yeah, so that's I think the most debated topic, Anand, these days. And if you look at not just in India, if you look at internationally also, right? I was just reading a very recent article wherein one of the most well-known there was, I think, a survey in which one of the most well-known institutional investor survey is there, right? And in that, one of the most well-known um, value investors also was said to be losing money from investors who are basically saying that, okay, that style is not working. So it is our firm belief that when people try to give up on a particular sector or a style, that's when that style probably is bottoming out. And if we see not just in India, even in US, the value stocks have underperformed the growth stocks by a very, very significant margin. The major reason for that, of course, is that if you lower interest rates, the moment you lower interest rates to zero, even a slight amount of growth gets repriced significantly. In other words, to put it very simply, if your interest rates are zero, which is what it is in the developed world, a company growing at 3% also can be given a multiple of 80, 90, right? So that's where today people who see growth are buying those growth stocks at any multiple, while the value stocks, both in India and US, are available at significant discounts, probably because they are not showing earnings growth. So yes, it's a clear yes as far as value is concerned. And today, given where the markets are, if you have to look at 3 or 4 year horizon, value as a category should do well. Broader markets also should do much better than probably just the few stocks in India and the few stocks globally which are doing well.
Good to hear someone talking about value stocks finally, right? Shifting back to the next question, so what is your view on the commodities like gold and silver?
Yeah, so as far as commodities in general are concerned, if you see whatever has happened in the last 6 months, especially post COVID-19, um, the response to COVID-19 is very similar to the response in global financial crisis that we saw in 2008, wherein the central banks came in, be it the US Central Bank, which is the Federal Reserve, be it the European Union, which is the ECB, be it the Japanese Central Bank. They all came in and printed money in huge sums. If you see the US Central Bank, they printed about $3.5 trillion of extra money in 4 months' time. That is on a base of $4 trillion that they accumulated over a past maybe 150 years or 100 years of existence. So $4 trillion was what it was somewhere around March. Today it is about $7.2 trillion. This incremental $3 trillion is huge liquidity infusion, which actually is where you're seeing the asset classes or all the financial assets going up, right? Bonds are going up because interest rates are falling. Equities are going up because the money which has been basically released through the central bank is finding its way in equity. And when you reduce interest rates to zero, think about it as an investor. You are sitting in US, you have a 0%, virtually 0% in fixed income instruments or 1% versus equity markets which potentially are looking better. You are basically attracted towards the equity market. So flow is moving towards the equity market. So in US, if you see the real estate, equity, and bonds, all three are basically being lifted up because of the high increase in liquidity available by central banks. Right. So I think that's one reason. That's one reason why even gold, for that matter, you mentioned about gold. The interest in gold is also increasing because of the fact that there is easy liquidity. And in general, it has been seen in the past, right? If we see 1970 to 1980, if we see 2000 to 2010, whenever there is a confluence of events like high US fiscal deficit, high US debt to GDP, increase in Federal Reserve balance sheet size by printing more money, and obviously interest rates which are very low for long, you find that gold as an asset class ends up probably doing well. So I don't know, I can't crystal guess what gold will do eventually. It's not for me to decide. But if I see the past history, then at least the factors which influence a positive gold cycle are today existing in US. Now, do they change after the US presidential elections? And if there is a change in the US presidency, we don't know. So we have to keep a watch. As things stand right now, gold has obviously done is the best asset class, one of the best asset classes, if not the best in the last 1 year.
Right.
And so we have to be also cognizant of that fact that there has been a rally in when we are speaking right now.
So will it be a strategic or a tactical call in that case then?
I think gold from an investment perspective should be a strategic call for investors in general in the long run. Having said that, we must remember that there was a period between 1980 and 2002 that gold gives 0% return. So
Right.
what price of gold was in US dollar terms in 2000, in 1980, in 2002 also the dollar price was same. In India, of course, we get the benefit of rupee depreciation, which gets translated into gold price. So we probably haven't seen that 22-year flat return for gold. So after a large rally in gold, and has the largest rally or the large rally happened, I don't know. But after a large return in gold, gold can be sideways as well. So I think the core which we always advise to investors is keep your asset allocation right. If your asset allocation allows a certain percentage of equity, debt, and gold, stick to that asset allocation. And I think you should be fine in the long run, because whether 10% is right in gold, whether 20% is right is gold, it depends upon a lot of factors which are individual to each of your investors. So I would say that keep the asset allocation right. And yes, it is a strategic call. It is not necessarily a tactical call that you can play. Yes, in terms of tactical call, if you want to increase the exposure to 50-60% in gold, definitely it can be a tactical call. But I am not for it or against it. It's up to your investors to decide. But yes, gold, in my view, till such time as the central bank balance sheets are expanding and 0% interest rates are there, not just gold, I will extend it to all commodities and all the basic inflation linked commodities. Inflation will be back probably in the next few years, and so the commodity prices will also start reflecting that, because money will translate into something tangible. So it's already happened in equities, debt, gold in some manner. It may happen in the real economy and ultimately in metals also.
Okay. So then question around gold again is, should we buy gold mining companies which are still trading at a little suppressed valuation as against buying gold directly?
So I think it's probably easier for investors to buy gold directly in many forms, right? Starting from SGBs to gold ETFs to gold fund of funds. As far as gold mining companies are concerned, what I have seen in the past is that they have different cost curves, and based on the different cost curves, their beta to the market is also very different. So if we look at it, if I was as an investor, I prefer gold over gold mining companies, but I think investors can do their own research and probably figure out what fits them well. But I'd say betting on gold is better than betting on gold mining companies.
Got it.
Chintan, you just mentioned the surge of liquidity which is driving the asset prices globally. How should investors navigate this surge in liquidity and the prices affecting assets in general, the high prices that we buying assets today at, and what are the traps that one should look out for in such liquidity driven rallies?
Yeah, so I think there we firmly believe that it's always important to keep, again, the asset allocation in mind. What would be a trap? The trap would be very simply being 20% in equity in March and suddenly increasing the equity allocation to 80 today as we speak, when the market has already moved from, say, 7,500 on the Nifty to 11,500 odd right now. So if the market has rallied 30-40% and then your equity allocation goes from 20 to 80 at this time, at this juncture, it may be a trap where you'll probably get beaten on both sides. So I think for majority of the investors, the market return is not the investor return because of this greed and fear. And I think that's where, to avoid that, the dynamic asset allocation fund category from an investor perspective suits the most, because there you're obviously buying when the markets are low, selling when the markets are high. So each investor, of course, has their own styles, but I would believe that it is very important, especially these liquidity driven rallies, because what we've seen in the past, liquidity can come quickly, We don't know whether it will extend for a long period of time. And when we don't know when it goes away also. In the last 5, 7, 10 years, we've seen enough that suddenly liquidity goes away, suddenly markets become sideways, they fall, again liquidity comes back. It's totally determined by what is the central bank stance, and we cannot predict the central bank stance. Hence, what we can predict and what is in our control is our own asset allocation, and it should be rational. And that's where keep that asset allocation in check. I think investors should be fine.
Chintan, India, has turned CAT positive essentially due to low imports that we have had over the last 6 months, slowdown, low oil prices being low. Do you see a significant risk to this when oil demand picks up, when demand in general picks up, and oil prices go, northwards? How do you see this, kind of moving? Right now, we are low on inflation, low imports, low bills. But once the tide turns, how will this favor us or kind of put us out of favor?
Yeah, so as far as the current account deficit is concerned, you are right. From a very bad situation in 2013-14, where we used to run 4.5-5% current account deficit when oil was at 100, and of course gold prices were also high, and we were importing a lot of gold. Today, if we see, because of the lockdown or otherwise, gold imports are lesser. I think there is a beautiful scheme by the government for financially investing in gold, which is also picking up, which also means that the gold imports, at least from an individual investor perspective, are coming down. And crude prices, of course, are helping the most. However, I think from an India perspective, given that we have a very buoyant FDI investment, we have a very high chance of seeing FII flows coming in also. I won't worry too much about current deficit going to 1%, 2%, or 3%. If oil price goes to 60, 70, $80, should there be growth coming back? Because ultimately, as a country, we should see whether our balance of payments is fine. And if RBI has $535 billion of reserves, which is sufficient to cover about 13 months of imports at today's prices, or 12 months of imports, we are comfortable on the foreign exchange front. So the balance sheet front, we are very comfortable. I wouldn't worry too much about the current account deficit going up. In fact, if the current account deficit does go up because of the right imports, right? We are importing for increasing our manufacturing prowess. If we are importing for increasing our capex, it is in the right direction. So both fiscal deficit and current account deficit, I wouldn't worry too much about it, because fiscal deficit means if the government is spending more in the right direction again, and to basically take care of that investment, if there is imports happening of capital goods for further GDP growth, it is in the right direction. So I wouldn't worry too much about it as long as it is well directed.
The next question is on how are you picking up stocks across your schemes and still creating value for investors? Like you mentioned, it's been a very narrow rally and only few stocks have gone up. So how are you kind of playing the new normal in terms of buying stocks at high prices, or how do you kind of just wanted to understand more on how ICICI does investment in various schemes for clients, for investor money in markets like these, where the rally is very narrow and the broad-based rally is yet to happen.
Yeah, so effectively, if we see, Girish, it is very important to actually have the processes in place to ensure that we don't end up having a pro-cyclical approach. So what we do at ICICI Prudential is very clear. We have a counter-cyclical approach. You will rarely find us increasing our weightage very significantly in a stock or a sector which has suddenly done too well. So instead of chasing momentum, we rationally allocate our unit holders' money in a way that they should find long-term wealth creation, at the same time keeping risks in check. We are not in the business of trying to maximize returns for the investor at the cost of not focusing on risks at all. So if we focus on risk and if we manage that risk well, in the long run, the investor returns will be taken care of, is what we firmly believe. And in conjunction with that, if you see our portfolio positioning today, the pockets of market which are probably the cheapest, if I can use that word, right? So what is expensive today? Probably FMCG to an extent is expensive. So we will have probably lesser weight in FMCG, and that's been the case for a while. Apart from FMCG, if I see on the buying side, clearly power utilities is something I cannot live without power. I mean, even today, this interview wouldn't have been possible without power. And power consumption, the good news is that it's reached the pre-COVID level, or last year at this time, the amount of power that was required in India, we've already reached that. So clearly power is something which we all will need. And from that perspective, power stocks or power utility stocks today are very cheap. So power, Telecom, another requirement. Can we think of a life today without telecom? The answer is no. And hence, I think 10 or 12 hours of my time goes into in some form or the other of telecom equipment or data. So clearly, that space is also something which we like. And if I have to go towards banking, which is the largest, yes, there have been troubles because of the lockdown, moratorium, etc., which has brought down the valuations of many of the large banks. But if we see over the last 3-4 months, those large banks have showed up their balance sheets by raising more capital. And when the growth comes back, which it will in the next 1 or 2 years, or it should in the next 1 or 2 years, you will find that these banks will be in a great position to capture that upside. So maybe not immediately, but banks definitely seem to be well placed to capture the upside in the economic cycle. And we must remember that whenever FIs want to play any economy in terms of an economic recovery, the first thing they come and buy is the banks. So banking sector is also something today after the underperformance which we like, and we are gradually building it. Much of 2018-19 we ran an underweight in banking because we felt that banking was probably very overbought, over-owned, and we needed to be careful in that sector. So we were careful, we were underweight, but now we are probably adding on to it as we move along because of the valuations becoming cheaper. And I think metals we already spoke of, right? In some of our schemes, we had taken a call on metals and has played out. Going forward, it's a bit difficult to predict because we have to see growth coming back, and I think dollar and eventually dollar should depreciate. And if that dollar depreciation because of the increase in availability of dollars in the global world, I think that's where also metals and these cyclical stocks or sectors should do well. So clearly, value over growth is something which may potentially end up doing well. And more importantly, the old economy stocks, which probably did not participate for the last 10 years, like construction, forging, casting, etc. There's a auto ancillary. There's a plethora of sectors and stocks which may end up doing well. Even textiles as a sector is something which will actually do well in the next 1 year. So anything and everything to do with manufacturing or old economy or value should do well over the next 1 year or so.
So what's your take on healthcare?
You gave a very beautiful one-liners on all these sectors. One question from my end was that what are the key 2-3 risks that investors should watch out for over the next 6 to 8 months in terms of where these markets are headed?
So the biggest risk I would say is the fact that today, because of 0% interest rates globally and these low interest rates, there is a sense of let's say euphoria in equities in US in some sense. Not so much in India. We are bordering on optimism, but not euphoria. And why do I say that? Just look at these numbers. The market cap to GDP of US is about 165% or odds. Market cap of GDP of India is about 85-90, depending on what you take as GDP, FY21 or FY20. But let's say 165 and 90. These same numbers, if we go back to 2008, India market cap to GDP was 160%. We were a $1 trillion GDP with a $1.6 trillion market cap. Today, of course, we are much, much more moderate in terms of market cap to GDP. So, in a sense, what I'm trying to say is we've had a decade, last 10 years, wherein the earnings growth in the market is sub 10. I think it's about 6-7% or 5% odd. The 10-year CAGR returns in the market are close to 7-7.5%. So we are in single-digit returns at a time when our interest rates in India used to be much higher. Maybe next 10 years, interest rates will be lower. The GDP growth may look much better as we move along with a lower base of FY20, FY21, of course, and with the dollar depreciating. Now, whether the dollar will depreciate or not is also a risk, and you ask me respect us. We will ultimately see growth happening. But the biggest risk, as I see it, is that if this liquidity-driven rally shifts from a 0% interest rates, if interest rates start to go up, if liquidity dries down, that is one risk. Of course, we are nearing a US elections. What we've seen in general in the past history is that whenever US elections or around US election time, at least in US, the value stocks start doing better than the growth stocks in US. If that repeats, and probably in India also we may see repeating, and hence the liking for value stocks also increases that much. But 3rd November or around that, the elections are there. That is also one risk we should keep in mind. Given this 160% market cap to GDP, is it sustainable? Has it ever happened? No, it is all-time high. So we have to be careful. The easy liquidity has caused mispricing in bonds, has caused mispricing, has basically allowed many corporates to take easy debt. So the debt burden globally is also high. Today, US debt is as high as 1944 World War II levels, right? So they are at one of the highest debt to GDP also. So I need to be, or we need to be very sure that whatever investment we have in equity today, while it may do well over the next 3 to 5 years, we should be very clear that it is money which we won't need for the next 3 to 5 years. So to that extent, our investment horizon matters on the equity side. On the debt side, however, I'm extremely comfortable. We find India very, very comfortable on the debt side, but we'll come to the debt side later. I think you have questions on debt later. Thank you,
Yes.
Girish.
Yes, I do have questions, but just before that, I just want to touch base upon the valuation of healthcare sector on a whole. Do you think it is overpriced right now? Because people are keen on investing in it right now.
So yeah, if you look at what we did probably 2.5 years back, we felt that that's a sector which was undergoing a correction phase or a consolidation phase after a correction between 2015. So I think if you look at healthcare sector, 2010 to 2015 was one of the best periods for healthcare sector, where I think because of the many of the patented drugs going off patent, the Indian generic companies got the benefit of that between 2010 and 15 in terms of their growth and earnings. And then when that fell off a cliff, and there were then FDA issues, etc., which kept on coming. From 2015 to 2019, the sector first went down and then was consolidating. I think today we are probably in that space wherein the sector is neither too cheap nor too expensive. I wouldn't say that it is very expensive. Why do I say that? Think of it this way, that there are three sectors which are considered as defensives in India. One is FMCG, one is IT, which is technology sector, and I think it is a very important sector for us, and healthcare, which is again a very important sector. About 1 year back, if you had asked me, I was liking pharma a lot more than technology, and then FMCG. FMCG was even expensive then. Today, probably between pharma and tech, I'm probably neutral in both, because both have actually done well. Today, in fact, if you look at 3-year returns, some days back I had seen, on a 3-year return basis, technology sector is one of the best in Nifty. It's about a 20% CAGR return. So has technology already done well? The answer is yes. But then there are good quality companies, good balance sheets, buyback support, etc. So if you ask me in the pecking order on the defensive side, tech, pharma, and FMCG would be my pecking order. But both tech and pharma are likely to be defensive, which will be bought into, given where we are in the environment in which we are. The only thing which we should remember is that if dollar has to depreciate, rupee may be slightly higher. And in a slightly appreciating rupee, at least the foreign earning or the foreign earnings are very high in these sectors. So we have to be careful on that aspect. Their earnings growth gets impacted because of rupee appreciation. Of course, they do hedge their receivables, and so 1 year we may not see that impact. But if rupee does appreciate for a longer period of time, you will start seeing that effect maybe 2 years, 3 years down the line. So next 1 year, I'm very comfortable with tech and pharma.
Got it. So good, you're talking about USD. I mean, I was reading somebody's note, and he said the US dollar index is expected to correct another 3, 4, 5% or so, which is yeah, I understand USD. The US dollar index is primarily euro, but do you see dollar coming down against emerging currencies as well? If it goes to 88, let's say, I don't know where the price of USD INR will be then by then.
So predicting currency is extremely difficult. There are too many moving parts, but based on whatever I have read, Anand, one, we've seen 2010 to 2020 US appreciate significantly versus Euro, versus Japan, versus, of course, all emerging markets clearly. The joker in the pack is the debt of emerging markets. Now, while in India, we've been able to beautifully manage, especially in the last 6 years, we've not increased our debt to GDP in a major way. We've not increased our fiscal deficit. So we've been very responsible. We've basically have made our balance sheet very strong, right? When oil prices have also fallen, by not passing on the oil price fall and by taking the revenue out of it through the taxes on diesel and petrol, what has happened is our balance sheet has been strengthened. So as a country, we are much stronger compared to our Asian peer group. So if you ask me, will euro benefit out of dollar depreciation? The answer is yes. So euro is about 38% of the dollar index basket. So euro will benefit, and that's where the European companies may benefit a lot because of the depreciation of dollar because it makes their exports that much more competitive. US imports increase significantly from Europe. That's been the case, and that's where if you find since the time the euro has come in, euro and US keep on playing this toggling game, and one benefits to the expense of the other, next other benefits to the expense of the previous one. Japan, of course, is going to be a beneficiary, and that's where we like, in fact, the Japanese markets. In one of our funds, which is the Global Advantage Fund, we do have investment in Japanese markets. The next is, of course, India, and where will the rupee go? So again, a difficult choice, but given the environment where I said that there's so much dollar which is being printed, 0% interest rate, US fiscal deficit is very high, US real rates are very low, US debt to GDP is extremely high, and they are printing money. All of this confluence means that dollar has to come down. And if dollar has to come down in a country like India, where we have a strong balance sheet, FIs will be happy to put money, not just a strong balance sheet, but interest rates which are high. Think of it, probably 2008, if I go back, India 10-year used to be probably 8.5, 9 at different points of time, and US used to be maybe 5, 6. That 5, 6 of US has come to maybe less than 1 or 0.5, and India is still at 6. In fact, if I just look at last 3 months, I don't have the chart in front of me, but I show it in my general discussions. In the last, not 3 months, but since January to today, US has fallen from 3% odd to 0.5%. India is still there and there. So we have managed to have an environment wherein we've not allowed interest rates to reduce too much, because when interest rates reduce too much, it does have a negative impact on financial assets beyond a point, because people forget risk and they just go into financial assets, which causes bubbles. So if you ask me, is there a potential bubble in US equities? The answer is yes, but or I would say it is brewing. Whether it is a bubble, whether it is overvaluation, or whether it can be justified because of zero interest rate, I don't know. But I would be worried about US. And in India, coming back to a question on currency, it looks like we may have a time period like 2002 to 2008-9, wherein rupee was strong despite a high inflation differential with US, right? So ultimately, why does a currency depreciate? When the inflation of one country is more than the other, the country which is having a higher inflation should see their currency depreciation. But in India, for the next maybe 5, 7 years, even though inflation may be higher than that of US, we may not see currency depreciate. It may slightly be upwards. But it all depends on what's going to happen with the other Asian currencies. And if I go back to 1995 to 1997, there can potentially be a worry of a high debt and Asian financial crisis type of situation, 1995 to 97. So not a simple solution, too many variables, but we have to stick to asset allocation is what I believe. Thank you.
So finally on the debt, so RBI did release a lot of moves last week. So do you think with that, the upside is more or less capped with the yields being at about 6 quarters, maybe the max, and it can come down from there?
So I think clearly at a time when there is a negative 23% GDP print which has happened, right? For this year, it is basically it is estimated that it may be minus 10% growth for GDP this year. In a minus 10% growth GDP this year, to have 6.5% interest rate on the 10-year at a time when globally interest rates on sovereigns is coming down. That was an anomaly because of the fact that probably people felt there will be too much borrowing. And when there is too much borrowing, obviously the rates went up. There were various reasons which were there. I think with these measures which RBI has basically announced, interest rates at least will not go up. That is clear. How much will they come down will depend on what is happening with the environment. Suppose if you say that all this dollar inflow means inflation can go up in India, commodity metal prices go up, equity start doing well, and growth comes back. So say 1 year down the line, we are talking of 9% real GDP growth.
Right.
If you talk of 9% 1 year down there and real GDP growth, or 10% GDP growth, then in that scenario, to have interest rates very low or going down looks difficult. But today, as we speak, over the next 3 months, it is our view that interest rates will go down, not just on the government bonds, but we have a very high mispricing on the yield side in the credit space also. That should also come down, because if you have the right credits, they are also trading at very attractive yields at a time when risk-free rates are very low, right? 3, 4, 5% rates on the best quality bonds we have. At the same time, AA and A can be 8, 9, 10%. So the idea is if you can pick the right securities, there is money to be made. So yes, duration and credit both are something which we like right now.
That's great, Chintan, and I would really thank you for taking your time out on a working day. It was really insightful, to say the least. I have a few more questions to ask, but I'll take it offline. Thank you again for participating.
Thank you, Chintan. Thanks for your time.
Thank you. Bye bye. Bye bye. Take care. Bye.